Bhuvnesh Singh, Managing Director and Head of India Research with Barclays, joins us live from Singapore. Bhuvnesh, good morning and thank you for joining us. Bhuvnesh, in last 3 months, Indian markets have clearly oscillated between hope and despair. On a daily basis, we have seen deadly volatility, too much of back and forth action, but markets are refusing to go down. So what's going on?
I think what you're seeing is across emerging markets, and we are seeing the same hope and despair phenomena. However, instead of bringing India-specific reason, this is largely led by the macro policy of the central banks around the world. So Fed taper policy is maybe one key thing to blame over there. And going forward, as we continue to look forward in next 12 to 18 months, the actions of central bank, when the Fed starts tapering, how much does it taper, where the global interest rate goes, that will be the big driver of the local markets rather than just the local issues. For India specifically, one local issue will be in forefront over the next 12 months, and specifically over the next 6 months would be the Indian central election. So the state elections in December and post that the parliamentary election in May would be another big issue for the volatility in the Indian markets.
Bhuvnesh, while we await what transpires out of the elections and how the market absorb it, do you think in the near term, post the second quarter earnings, now it's the RBI policy next month which is going to be imperative in terms of giving us a direction?
Maybe, though I have less belief in that. RBI under Mr. Rajan has been an excellent central bank, and we were very positively surprised by the actions he took after he took charge. But he has already raised rates twice. So in the next policy, would he just suddenly stop raising rates or would he start easing? I will find it rather sudden. So I think for RBI, the tone is set. He wants to create an inflation fighting credentials. He also wants to be pro-banks, pro-business. And what we have seen specifically in the bank's results over the last 1 month or so, some of this is coming through. The NPAs of the banks were much better compared to what we expected. The overall results of the banking sector for the first time after a couple of quarters, we did not see earnings downgrade in banks. So his initial start is working very well. I do not think so that he will suddenly give away that advantage by talking a significant easing language or in his next policy address.
But Bhuvnesh, after the recent run-up, and given the kind of economic environment we are working with, in the short term, do you think markets have run up slightly ahead of themselves and there is a lot of speculative froth in the system?
It is always the case. So markets over a short term always will be either in bullish camp or bearish camp. So if we look over the next couple of months, we think some of these gains could be given away. But you should not forget on how the market has moved, let us say, over the last 12 months. Despite market being at all-time high, the Indian cyclical sectors, whether it is industrials or financials, have not led the rally. The rally is still being led by the exporters like IT services or consumer staples or pharmaceuticals, these stocks. So it is market over a 12-month basis have been much more rational than what we think. So short-term volatility aside, the long-term rationality of market is still prevailing.
Bhuvnesh, so tapering adjustment was the big trigger for Indian markets in the month of September. Then we saw a big earning adjustment or a positive earning adjustment in the month of October. What could be the next big trigger now?
If I may correct you, we did not see a significant positive adjustment in earnings. The last earnings season, BSE 100 earnings have hardly changed. It was 10.5%, 11% growth before, and it's 10.5%, 11% growth now. The constituents of earnings have changed. So IT services, energy, these have seen significant earnings upgrades. On the other hand, industrials, materials are still seeing earnings downgrades. So the earnings trigger has not come in India, and I do not perceive that it will come in over the next 6 to 9 months. The trigger for the India would still be macro related. What happens in the elections, what happens in the Fed. And post the 6 months back or 3 months back, we were thinking that Fed tapering is imminent. Right now, we are thinking that Fed tapering could be still some time away. What if there is a middle path? What if Fed suddenly again gives a signal towards tapering? So a lot of sentiment-related issues will continue to dominate the index movements, at least in short term.
So in the near term, Bhuvnesh, do you think the market will be able to defend the floor at 6,000, or do you think there is a possibility that we may slip significantly lower?
Again, depends on the macro factors. I think it will not be an India-specific issue. It will be more of a macro issue, and a number of emerging markets will move in tandem going forward. There is definitely a risk of that we can slip 6,000, I would say.
Bhuvnesh, so what is a good portfolio allocation in the current juncture? Should one still stick to defensives, or now it's time to throw out defensives and it's time to add risk?
I don't think so. The time to add risk has come yet. Over the next 6 to 12 months, the earnings numbers for Indian companies will continue to disappoint, specifically on cyclical sectors, while the export-oriented plays or the import-adjusted plays, they will continue to do well. So our portfolio recommendations, stay defensive, IT services, pharmaceuticals, energy sector, consumer discretionary sectors. These are the 4 sectors which we continue to prefer. We will be significant underweight on financials, on industrials and materials.
Okay, let's talk about the sectors one by one then. What is it that you like out of the IT pack? Give us your top 3 recos.
In IT services, it is very simple. If US growth is improving, definitely IT services sector could see slight uptake in revenue growth rate. The rupee depreciation is definitely helping. Rupee has stayed flat at 45 rupees plus minus 10% from 2002 to 2012. Suddenly in 2013, we are looking at normalized rupee levels of 60 rupees plus. That would be a huge beneficiary for IT services sector, not only in terms of the translation gains, but also in terms of margin expansion. So EPS growth of this sector could continue to surprise on upside.
Bhuvnesh,
and multiples, if you look at that, they're not rather expensive. This sector is still more of a cheaper sectors amongst the names which are delivering you 15% earnings growth.
Bhuvnesh, the key standout feature for the year 2013 has been that we have not seen a big, strong, revival in earnings. Rather, more than earning expansion, P multiple has expanded. Do you think at a time when global liquidity is extremely benign, we could see a further P expansion in top quality names?
Right now, the choice of FIIs in India have stayed between the top quality names. They are not moving out of top quality and going further down. This itself is a bearish trend for the market. So longer term, faith in Indian market needs to come back for investors to move beyond the top 20 names and invest in the next 50 names per se. Until the time that does not happen, it will largely be the large caps, which both from the PE premiums and from some amount of earnings growth will continue to drive the market.
So in the run-up to the general election, what kind of market range do you see? Do you think Nifty and the Sensex, they both will be range-bound?
I think both will be rather volatile, and from the current levels, we can easily expect plus minus 10% volatility for both Nifty and Sensex.
Out of the banking lot, is it a blanket avoid when it comes to the financials, or would you still prefer to be somewhat invested in the private banking names?
Within the banking sector, relatively private banking names are better. Within the private banking names, more defensive bets like HDFC Bank or Kotak Mahindra or HDFC are better. But overall banking sector, we still expect it to underperform the index.
Bhuvnesh, what have you made of the kind of rally that some of the metal majors have witnessed, especially the likes of Tata Steel, wherein the hopes are pinned pretty high on what the European part of the business could deliver?
And that is exactly the point. The names like Tata Steel are rallying not because the hope of Indian part has recovered, but suddenly you find the European part, which because the European economy could be close to the bottom, next 12 to 18 months, it could give you better returns. The other part of metals rally has also to do with China. Compared to say 3 to 4 months back, the optimism on China is back, and that has led to metals rally across the world. So it is again a globally driven rally and not an India feature which has led to these stocks going up.
Bhuvnesh, the standout performer really has been the entire auto group. If I look at the monthly dispatch numbers which are coming out both from two-wheelers and from four-wheelers, there is a lot of evidence, and there is some concern when it comes to the slowdown in the auto sector. Why are auto stocks sitting at a multi-year high despite tough market conditions?
Some of the auto stocks have an export component. Now, Tata Motors is largely driven by JLR, which comprises more than 3/4 of market cap for the company. So that has been a rather opportune acquisition by the company, which has paid them very well. For in case of Bajaj Auto, it is again significant export component which is helping them. Some part of the Indian auto sectors have also done well. And I think to some extent the numbers have been decent. The expectations went down sharply, and compared to expectations, numbers have been pretty okay.
Let's look at Maruti then, Bhuvnesh. Maruti clearly is a domestic story, and Maruti has done exceptionally well. Numbers were strong, market share gain has been decent, and what they've reported for the quarter gone by is not a margin compression but a margin expansion.
Yes, and I would say that across auto space, in some of the auto space, the expectations went down sharply, and compared to those, the stocks have done rather well.
So at Barclays at the current juncture, what is your big contra idea where as a firm you are leaning one side and other brokerages are leaning the other way?
Within the cyclical space, for example, we are very positive on Tata Steel, we are very positive on Tata Motors and Larsen & Toubro. So these three names have made a lot of money, and we still think that within the cyclical space they will continue to do well going forward. Outside the cyclical space, we are very positive on stocks like Kain India. In IT services, we are more optimistic on Infosys compared to other names. So these are again some names which people are not that optimistic on right now, which could perform better going forward. In the consumer space, we are optimistic on ITC, but we also have a cautious call on Hindustan Lever. So these are some ideas which would be very strong for Barclays.
What about the mid-cap consumption theme, the likes of Tata Global Beverages, or for that matter, names like a Titan or Jubilant Foodworks? Anything that you like out of that space?
No, I would not comment on them.
So in general, are you advising your clients that they should prepare or they should align their portfolio for a global surprise or for a domestic revival?
Largely for a global surprise, and within domestic also largely the election-related surprise, not a revival in terms of fundamentals or earnings of the companies over the next 6 to 12 months.
So when you say election-related surprise, could you quantify more on that?
I think what the last couple of elections have shown us that around the election time, depending on where the mood swings are, the stock index can move sharply. So at that time, we expect volatility to rise, and we would advise investors to accordingly position for that.
What names do you like out of the pharma sector, though?
Within the pharma sector, companies like Sun Pharmaceuticals, Glenmark, Lupin, these three are the names which we prefer significantly.
Now, Sun Pharma and Lupin they have delivered. Sun Pharma came out with absolutely stellar set of numbers, ditto when it comes to Lupin. Why do you like Glenmark? Because Glenmark numbers have been extremely volatile. It's an R&D company, and because of the nature of the business, there is a lot of volatility in the numbers.
Yes, and that's where the stock is cheaper. Glenmark in short term has shown us significant volatility, but if we look over the last 12 to 18 months, the stock has been consistent performer. So we expect that performance should continue going forward next 12 to 18 months.
What are the kind of sound bites you're picking up from domestic institutional investors? Because we know the mood of foreign investors. They are in a mood to buy into Indian equities on every downtick. But on the contrary, insurance firms and mutual funds are in a mood to sell Indian equities on every uptick. When do you think that selling will evaporate? Because that really could be the intersection point when DI become net buyers instead of net sellers.
I think it is not the domestic institutions who are the sellers. It is the domestic retail who's the investors in these domestic institutions. They are taking the money out of market. For the domestic retail, if you look at the opportunities available to them, they can easily make 8 to 10% out of fixed deposits. So for them to put more money in mutual funds, put more money in ULIP schemes, it becomes difficult when the market has not given significant returns over the last 3 years. I think going forward, as the market directions becomes more easier to predict, the volatility goes down, the retail will come back to the mutual funds, will come back to the insurance schemes, and then we would see more consistent buying by them.
Bhuvnesh, what about the currency? How big a factor or spoil sport could it turn out to be? Because we saw that last week, once the currency weakened, the equity markets as well felt the jitter.
The currency depends a lot on what the Fed says. So in the significant currency volatility would be led by the taper fears. But over longer term, we would say that just because of differential in inflation rate or the differential in interest rates, we would expect a rupee decline of somewhere like 3 to 4% per annum over a longer term.
Bhuvnesh, last question. I'm going to take the liberty of asking you a tough one. Give me one stock where you are advising your clients to bet their kitchen sink, where you're advising that they should have at least 8 to 10% of their total portfolio in that one stock.
Infosys, no doubt about that. Our view is that if you're betting the kitchen sink, you can't just bet on appreciation. You have to think about risk reward. We think that risk in the company is low. Reward wise, we would expect a 15% earnings CAGR and a similar stock price performance going forward. So we are very happy to own this stock over the next 1 to 2 year level.
This is not at 2,500, it is at 3,500. Is it too late to bet the kitchen sink?
No, we think that the revival in this company has just started, and Infosys compared to other large IT services stock has not been a stellar outperformer. So it has been largely in line. To some extent, it has been underperformer. So the stock levels are also to some extent related to where the sector is right now.
The utilization rates are at 72%, which is lowest in the industry. Now, the bulls would argue that utilization rates would go up, but the bears would argue that if utilization rates are low, that means business is not doing well.
Well, to grow at a 15% top line, Infosys can do it very well with a utilization rate of 83 to 85%. So I think it depends on what growth we expect. Now, 72% utilization rate is good if we are expecting a 30-35% top line growth. I don't think so either the bulls or the bears are expecting that. The growth expectations are more between 12 to 15% top line.
Bhuvnesh, really good chatting with you. Appreciate you taking the time out and speaking with us.